Think about the most stable, tangible asset you can own. Something that appreciates over time, provides status, and can be bought and sold with relative privacy. For centuries, that asset has been real estate. It's the cornerstone of wealth. And for exactly those same reasons, it has become one of the most attractive and pervasive vehicles for money laundering on the planet. This isn't about a few shady cash deals for crumbling apartments. This is about sleek skyscrapers in Manhattan, penthouses in London, and sprawling villas in Dubai being purchased not as homes or investments, but as financial car washes for corruption, drug money, and tax evasion. The real estate market, with its high values, limited transparency, and ability to leverage debt, offers a near-perfect environment for the three stages of money laundering: placement, layering, and integration. Today, we're going inside this shadow market. I'll show you the three primary methods criminals use, explain why major global cities are the epicenters, and give you the specific, actionable red flags that everyone from a first-time homebuyer to a seasoned agent should know. Because when dirty money floods a housing market, it doesn't just clean criminals' cash, it distorts prices, pushes out local buyers, and turns city skylines into monuments to illicit wealth. The most straightforward and historically common method is the direct purchase via anonymous shell companies. This is the integration stage made simple. They want a legitimate, high-value asset. They direct their lawyer to set up a shell company in a jurisdiction like the British Virgin Islands, Delaware historically, or a similar secrecy haven. That anonymous company then buys a $10 million property in London or Miami, often with a single, all-cash wire transfer from an offshore bank. From the outside, the owner of record is XYZ Holdings Ltd., a company with no publicly known owners. The true beneficiary is completely hidden. Upon sale, the proceeds are now a clean, legitimate capital gain from a real estate transaction. The shell company is dissolved, and the money is integrated. The red flags here have been glaring for years: all cash purchases, purchases made by corporate entities rather than people. For decades, in many prime markets, real estate agents and title companies had no legal obligation to ask, who really owns this buying entity? That is slowly changing, but the anonymity loophole was, and in many places still is, a wide open door. Because all cash deals can attract attention, a more sophisticated method evolved: the mortgage fraud or loan-back scheme. This clever technique actually uses the legitimate banking system to layer and integrate funds while reducing the upfront cash needed. Instead of wiring the full amount, they use a portion of their dirty money as a large down payment, say $1 million in cash. They then obtain a mortgage from a mainstream bank for the remaining $3 million. They make payments on that mortgage with their illicit funds. After a period, they sell the property. The remaining profit is now fully integrated, having been cleaned through the mortgage and sale process. An even more advanced version is the pure loan back. That company lends them the money to buy the property, creating a paper trail of a legitimate loan. They then pay back that loan with their dirty money over time. The funds are pooled with legitimate investor money, buying portfolios of shopping malls, apartment buildings, or office towers. The illicit cash is now indistinguishable from clean capital, earning dividends and appreciating in value. Its integration through diversification and obscurity. Even more opaque is large-scale development. A criminal invests dirty money as equity in a major condo development or hotel project. The funds are commingled with construction loans and other investors' money. The complexity of development finance, with its layers of contractors, cost overruns, and change orders, provides endless opportunities to inflate costs and siphon money out through fake invoices, a classy trade-based laundering technique within the project itself. Once the building is complete and units are sold, the criminal's initial investment returns as a legitimate profit from a successful development. The red flags in this arena are complex corporate structures with no clear rationale, developers who insist on using specific, obscure offshore subcontractors, and projects where the stated costs per square foot wildly exceed market norms without justification. The geographic targets of these schemes are not random. They follow a clear logic: global gateway cities with stable governments, strong property rights, and a history of welcoming foreign capital. Markets like London, New York, Vancouver, Miami, Sydney, and Dubai have been historically favored. These markets offer liquidity, the ability to sell the asset quickly. They offer prestige. And for a long time, they offered privacy. A kleptocrat from a collapsing state wants to park their stolen wealth somewhere safe. A luxury condo in Toronto is a far better vault than a bank account back home. The impact on these cities is profound and toxic. It drives up prices artificially, making housing unaffordable for residents. It leads to ghost neighborhoods of dark, empty investment properties. It embeds illicit financial networks into the very fabric of the city. The pro tip for observing this is to look at market anomalies. When a city's house price-to-income ratio becomes completely detached from local earnings, when a significant percentage of new luxury units are sold to anonymous LLCs, and when all cash deals dominate the high end, you are likely witnessing a market being used at least in part as a laundromat. The regulatory response has been slow but is gaining force. In the United States, a game changer is the Corporate Transparency Act (CTA), which as of 2024 requires most companies formed or registered to do business in the U.S. to report their true beneficial owners to a federal database. This aims to shatter the anonymity of shell companies. There are also geographic targeting orders (GTOs) issued by FinCEN, which temporarily require title companies to identify the true people behind all cash purchases in specific high-end markets. In the UK, despite promises, a fully public property ownership register has been delayed, but pressure remains. The common failure point has been the gatekeeper professions: real estate agents, lawyers, and escrow agents. In many jurisdictions, they have not been legally defined as financial institutions subject to strict AML reporting, creating a glaring loophole. That is now changing globally, forcing these professionals to conduct due diligence on their clients and file suspicious activity reports. The insider secret is that criminals are already adapting, moving to less regulated markets, using more complex multi-layered corporate structures, or shifting their focus to other asset classes like art, vintage cars, or even carbon credits. In conclusion, real estate money laundering is not a peripheral issue. It is central to the modern kleptocratic playbook. It transforms corrupt and criminal wealth into safe, respectable, and appreciating assets, often in the world's most desirable cities. It exploits the very human desire for tangible property and the industry's traditional culture of privacy and discretion. Combating it requires stripping away that anonymity at the point of purchase, empowering all professionals in the transaction chain to ask hard questions, and following the money trails across borders.